And in the appendices, you will see that they'll explain why dividend is not a factor. Okay, so in fact, investing for dividends alone does not guarantee that you have excess returns. So that's how they say that dividend yield is not predictive of future returns. They have very mixed results and they couldn't conclude that dividend is a factor. So this has very important implications in your investment strategy. So if you are especially a dividend investor, right, dividend yield might not be the one that you should be looking at. Maybe you should be looking at profitability, and on top of that, layer on a dividend yield as a second consideration rather than starting on dividend yield alone, because it's very poor predictions of your future returns. And as I mentioned, so dividend stocks tend to appear through factors like value or quality / profitability factor exposures. And dividends is really a very subset of earnings, because $1 earnings, besides giving you dividends, right, there are other ways that the company can reward you as a shareholder when they pay down the debt, or they do share buyback when the shares are undervalued. So there are a lot of other means that they can give you back the returns instead of just giving you in terms of cash. Okay, so probably that is why dividend yield alone is not a good factor, or not even considered as a factor. And something that they didn't put in the main book was this low volatility. And they, because of the very close similarity, right, they tackle this topic together with low beta. But in the strictest sense, low volatility does not mean it's low beta. Okay, the technical details we will not go through here, but just understand that it's not technically the same. They are largely similar, but there are some parts that are not the same. So for simplicity's sake, we'll just put them together. So it has been explained in the appendix why they did not include in the main book, because they said that returns actually came more from shorting high volatility stock than to long low volatility stocks. Unlike the rest of factors, right, all the returns are all generated from the long side rather than the short side. So they're saying that most of returns for low volatility factor comes from shorting rather than the buy side. Okay, so they did not want to include that. And second is that they also mentioned there are some risks at this point in time, because low volatility stocks are like bonds, right? And now currently the interest rate is very low, the chances of going up is very high. And if interest rate go up, bond price come down, right? So if low volatility stocks are similar to bonds, rising interest rate might be damaging to these low volatility stocks. And they also mentioned that after the financial crisis in 2008, a lot of ETFs and funds have created this low volatility factor exposure, and it has able to grow quite a large assets under management in these funds. So they also think that this factor is not a good time to put in a portfolio in view of all these scenarios that's been panning out. Okay, so whether you believe that this should be included in the main book or not is subjective, right? But in my point of view, I think they should have put this in the main book rather than in the appendices. And there was some unanswered stuff in the book that I would like them to cover, because not all the factors were covered actually. They also left out this investment factor. Granted that the investment factor is not as strong as the rest of the factors, but it is still a recognized one, especially Pharma and French has put them into their new models. So this investment factor is that companies that continuously reinvest in their businesses tend to do worse in the future. So it's a bit counterintuitive, right? So you actually think that companies who spend to expand their business is a good thing, but essentially that's not the truth, okay, to the research or the data that is trying to show. And I also wanted to see whether there are some other combination of the factors, but the authors only did the P1, P2, and P3, three kinds of multi-factor portfolio. More will be good, at least we can tell how they have performed in the past and roughly get a better sense which factors are a lot more complementary to one another. So in conclusion, this book is a good summary of decades of research, and you can just read so much research in just one book, and most importantly, it's simple to understand. Okay, and if you want to challenge yourself further, you can definitely read the research papers that the book has mentioned, because they are just quoting papers from papers to papers, right? If you want to get a full pictures how the study is being done, and you can definitely look at the bibliography, you are able to find those papers, okay? And of course, the authors have definitely added in their own worldview towards factor-based investing. They may not be right with everything, right? So it is good to ponder and to read a bit wider in this subject to gain a much more balanced view on this factor-based investing. But if you ask me, I think if you are interested definitely in a more quantitative way of investing, this is a book to be read. Buy it, keep it, and reread it from time to time, because it's almost like a textbook that you can use for a long time. Okay.